Okay, everyone, we are in the last chapter before our first exam, and this is the adjustments for adjusted gross income. So just to review the tax formula, we have the gross section. So remember, that's going to be net of anything that's excluded or exempt. And then we have our deductions for adjusted gross income. That gets subtracted out, and that gives us our adjusted gross income. And remember, what that is a major milestone on the tax return. Top of the first page, bottom of the first page, top of the second page. And that is a number that they use for a lot of phase outs. It's a number they use for a lot of ceilings and floors, and we'll talk more about examples of those into this chapter and also in chapter 5. And then we have the deductions from AGI, which we'll focus on more in the next chapter. We have taxable income, and then on that we calculate the tax with the tables, and then from that we can subtract some credits. And then that'll give us a tax due if it's a positive number. If it's a negative, it's a refund. We never show negative on the tax return if it's a refund. We just put it on a different line on the tax return. Okay, well, here we go. Let's start getting into it. And a lot of times these deductions are called above the line deductions. And if you look at the regular 1040 form, just the regular one, they actually have most of them listed in the bottom part of the form from lines 23 to line 35. Okay, and we won't hit up all of them. We'll just hit up some of the major ones. But before we get to that list, there's actually some more, so I'm kind of sneaky like that. Let's talk about the ones that aren't on that list. Okay, so I'm going to add a page here. If you notice in the gross income section of the 1040, there are a couple of lines in there. So one of them is a business income line. And let me get the form in front of me because I don't actually have the form in front of me. I don't have all of the lines memorized. I have a few of them, but not all of them. You don't need to memorize the lines anyway. So that's line 12. And then another example is line 17, and that's rentals and royalties. So those two lines actually have 4 AGI deductions buried in there. So an example is that the business income is actually reported on another separate form called the Schedule C. So that's one of the supporting forms of the 1040. And what that basically has is your income from a business minus your business expenses that you would take as deductions. So any business expense that you deduct on your Schedule C is also considered an above the line or 4 AGI deduction. Same thing with the rental. That's reported on another supporting document called the Schedule E. And so if you had like a rental property, you'd have rents, and then you'd have rent expenses that are deductible, and those rent expenses would also be considered above the line deductions. Okay, deductions for adjusted gross income. So just wanted to let you know about those. Deductions on a business, deductions on rentals, those would also be considered above the line for AGI deductions. Okay, now let's go to some of the ones that they talk more specifically about in the chapter. The first one they talk about is the student loan interest. Now, if we're going to talk tax reform, this hasn't changed. So as far as I know, the educational benefits from a tax standpoint, like any credits you get or certain deductions, those have survived the tax reform. So this stuff really hasn't changed. So with student loan interest, this is basically if you take a loan out to pay for qualified tuition and other qualifying college expenses, the interest that you end up having to pay on that loan becomes deductible up to a certain amount. And I believe it is a $2,500 maximum. Okay, which if you're paying about 6.5%, I think the going rate on student loans is around 6 or 7%. If you owe more than like $42,000 or $43,000, okay, you're no longer benefiting from this deduction, so you're just paying interest that you're not going to benefit from. Another thing to know about this one is actually subject to a phase out. And remember what a phase out is that when your income gets to a certain level, certain tax benefits start to disappear. They go away, and until they disappear completely. This is one of those that is subject to a phase out. Now, you don't have to memorize any phase outs. If there's a phase out associated with a problem in your test, I'll give you the phase out. But I do want you to know that the limit is $2,500. Now, just remember that, and I think there's a problem in the homework associated with this, is you don't want to include any portion of the debt that went to non-qualified expenses. You don't want to deduct that interest, the portion of it. Another example is if you had a scholarship, and that the scholarship is going to take priority over the student loan. So, let's talk about this real quick. There's a discussion. I think there's a thing on the discussion board I responded to, but for instance, let's say that we had scholarships, and then we had student loans. And let's say the scholarships were $2,000. The student loan was $1,000. And we had to pay qualifying expenses of $2,500. Okay, well, the scholarship is going to come first, and it's going to eat up of those qualifying expenses $2,000. So that only leaves $500 for the student loan. So if I had to pay interest of, let's say, $100, well, I know that only half of the student loan went to qualifying expenses. Okay, and so let's just put that qualifying expenses. Because if it's just money we took out to party or something like that, that's not supposed to work. Okay, because I know a lot of students out there, they just take student loans out and try to live off of them. That's not what they're designed for. They're designed to supplement at certain stages of your life tuition costs, or subsidize it, I guess, for a period of your life. But it's not supposed to be for like food and stuff like that. So you have $100 of interest. Well, this student loan, only half of it was taken up by qualifying expenses. So what we would do is we would take the qualifying expenses over the loan. We'd get a ratio and a percentage, and then that percentage would be multiplied by the interest amount, and our deductible portion is only $50. So that's a basic calculation of how it works. And I believe you have to incorporate that in your homework. But in the book, they tell you, and so this is something you want to know for your test is okay. Things that things that you have to reduce the qualifying loan by. So like employer paid educational assistance, funds withdrawal from a Coverdell, one of those tax exempt accounts that I told you about, tax-free scholarships. So you'd have to reduce like the tuition amount by any of those benefits you get before you apply the expenses to the loan. All right, and oh yeah, and they give you the form 1098E. So 1098s, those are items that normally show you a certain deductible expense. Oh, sorry, there's a motorcycle going by. I'll stop for a minute. Okay. So 1098s normally are forms that show some kind of qualifying expense that's deductible. And they report that to the IRS so that if you try to deduct it on your return, the IRS will match. Okay, how much are they claiming on their return? Okay, how much have these institutions told us that person actually paid? And if there's a discrepancy, they'll sometimes it'll trigger a red flag, and you'll get some letter in the mail saying, "Hey," and yeah, so there. So like you get a 1098-T for tuition. If you have a mortgage, they use a 1098 with just a 1098 regular from the bank. Okay, moving right along. I'm going to go to another page here. And we're going to go to the health savings account, the HSA. Okay, so the basic thing about an HSA is it's a way to save money. And the cool thing about it is, okay, so you're paying these premiums on insurance, and you're paying into this savings account, and special kind of savings account. You get to actually keep the money. Okay, so some of these other regular plans that don't have this, you don't get to keep any of the money. It just goes away and you start all over the next year. With this one, the balance just builds up. Whatever you don't use, you get to keep. So you put money into it, and if you're healthy, you never have to go to the doctor. You never have any major procedures that you have to undergo. No emergency room visits, nothing. Then you'll build up some fat stacks of cash in this thing if you're putting money into it. And the cool thing is you get a deduction a lot of times. You get a tax benefit for how much money you put in. And then whatever you take out, you don't have to pay any tax on. So you get a deduction when it goes into the account, and then you don't have to pay any tax when the money comes out of the account. The caveat is whatever money you take out has to be spent on qualified health stuff, not plastic surgery. Stuff like like you're sick or something, or have get corrective surgery, but not plastic surgery. Doesn't work for that. Okay. So what are the stipulations here? Can anybody just put money in a health savings account? Well, no. So you have to be actually on what they call a high deductible plan. So here at ACC, we actually have this option. The thing about it is it's normally going to entail more out-of-pocket costs. Okay, so a high deductible plan, it's normally going to be more out-of-pocket. So if you're somebody who has to go to the doctor or the hospital all the time, probably not going to be the best thing, even though you can put money in a savings account. So for me, like I've got a special needs child, so he normally needs quite a bit of stuff throughout the year. So I don't think that a high deductible plan would be good for me. But it really sounds awesome to be able to throw money in there and let it build up, because I just love saving, especially if it's tax favorable. Okay. So they have in your book the maximum deductible amounts. So the yeah, so maximum deductible $1,300 for individual. No, the minimum deductible for a high deductible plan. Excuse me. So it has to be a minimum deductible of $1,300 and $2,600 for individual and family. And this is just reading it out of the book. The maximum deductible or annual out of pocket is between $6,550 and $13,100. Now the as far as how much money you can put in a year, because that's limited too, because otherwise, I'm just going to throw $100,000 in there. You can get a huge deduction for it. So there is an actual maximum. And for a family, if you're under 55, you can put in $6,750 in 2017. And if you're 55 or older, so that's under 55 years old. And if you're 55 or older, you can add an additional $1,000 to get $7,750. Yeah, and I think this is also in 2016. It's for both years. Those limits apply. Alright, cool. And they show you two forms there. The 5498 essay, that basically shows you how much money you put into the plan. And then the 1099 essay, oh, there's another motorcycle, shows how much money you took out of the HSA, of the health savings account. Alright, moving expenses. So let's talk about moving expenses for a little bit. So this is normally, it's got to be job related, and they've got a distance test. The moving expenses were killed in the reform. So you're no longer going to be allowed to deduct moving expenses starting in 2018. Unless you're in the, like I think in the military, there's an exception if you're in the military. But in 2017 and before, you could, if you were moving for a job, and you weren't getting reimbursed by your employer. So if your employer was paying for the move, you can't take any deduction. If you had to pay it all out of your own pocket, then you could take a deduction for it. But there had to be a certain amount of distance, and they have all those details in your book. Like the new job from your old job, or the distance from your, something from the new job and the old job. There has to be, it has to increase your commute like by more than 50 miles or something like that. To be the distance test. I'm kind of running fuzzy on it because now that they've killed it, I'm kind of like, I just want to forget about it. Except for if I have to calculate it for 2017 returns. So I'm not going to make you memorize this for your test. There is a homework problem that makes you do a moving expense form, and just some of the main stuff to remember is what it was for. It was for moving, like, your stuff. it wasn't for, you can't like deduct any house shopping expenses, like, oh, I went to go house shopping to find a place to live. That's not going to work. No, the expenses you incurred to move your personal effects from one location to another, given the distance test is met, that's what you can deduct, what you had to pay to do that. Now, like the moving truck, basically the only thing, not meals. So meals are not deductible for moving expenses, so packed sandwiches. But like if you had to stay in a hotel on the way, they'll normally let you take a nominal amount for that. They'll let you take mileage on your vehicle of around 12 cents a mile or something. And you can also deduct not fuel if you're taking the mileage. You can like if you had to pay a moving truck or something like that, that would work. A moving company, if you paid a moving company. So all that stuff. But again, starting in 2018, this is no longer available unless, I believe, you're in the military and you have to move from military service. So this will not be on your exam. I'm not going to make you try to memorize that for a test when it's dead. Okay, but doing the stuff, if it's an open book, doing a homework problem on it, I think is a good exercise, good exposure. All right, moving right along. Self-employment tax. So this is definitely very much alive and well. Let's talk about self-employment tax real quick. So if you ever get paid one of these, okay, so normally if you go out and get a job, more commonly you're going to get a W-2, and that means you're an employee. You've been employed. But if you get up to somebody and they tell you, you know what, we basically pay everybody a 1099, so that means you're an independent contractor, and you essentially just have your own business. Okay, a lot of employers try to do that so they don't have to pay employment taxes, so they don't have to pay payroll. So when you're paid as a W-2 employee, they take out taxes, they have to pay a portion of your Social Security and a portion of your Medicare. So when you see Social Security and Medicare on your check, whatever amount you see on your check, on your pay stub, so whatever amount you see for those two taxes, your employer is having to match that amount. So if you say, oh, they took $500 out for Social Security and $150 out for Medicare, that means your employer took another $500 of their money and paid it to the government for your benefit, as well as the Medicare. So if you're an independent contractor, they don't take any of those taxes out, and they don't pay the portion for your behalf. So if you're an independent contractor, you're essentially considered self-employed, and you have to pay both sets. So you have to pay your portion of the Social Security and Medicare, and on top of that, you've got to pay the employer's portion of Social Security and Medicare. So that's where the trouble in paradise comes, being self-employed, is you have to pay an extra like 8% of your income out to employment taxes. Okay, so what does the government do? Well, they give you a little bit of a break. They say, okay, well, if you have to pay both sets of taxes, the employer's portion, we'll let you take a deduction for that. We'll give you a deduction for adjusted gross income and the amount of the self-employment taxes you have to pay, the employer portion. So basically, it's 50% of the self-employment tax, and I'm just going to abbreviate that SE tax. So whatever you calculate, and normally it's going to be about 50% or 15% of your profit, you multiply that by half or by 50%, and that's how much of a deduction you can take. So remember, the SE tax is based on your profit from a business. So if you have a Schedule C, so that's what you have to prepare if you're self-employed most of the time. Let's say your 1099 miscellaneous you got from this job. Let's say at the end of the year it was 30 grand. Okay, but what you can do is when you're an independent contractor, you've got more options about deducting expenses. As an employee, almost nothing. You cannot deduct anything if you're an employee. The government wants your employer to reimburse you for any expenses that you have to pay. So if they say, oh yeah, you need to buy, this and that, or you need to travel somewhere, the government wants you to be accountable, prepare expense reports, submit them to your employer for review, and then if your employer approves those expenses, they'll reimburse you for them. But if you have your own business, well, yeah, you've got more expenses that you can deduct. And so let's say, oh yeah, I had to drive around to a lot of different job sites, so I took mileage in my vehicle. I had to buy some tools to work with that my employer wouldn't provide, but they required. So let's just say, all right, I had $10,000 in deductions, qualifying expenses. So my net income or net profit of 20 is basically going to get multiplied by around 15%. Okay, it's not exactly that amount, but it's around 15%. And then that amount is going to be self-employment tax. So 15% of 20,000, I believe, is 3,000. Check my math for me. Okay, so that would be my self-employment tax. I'd have to send that to the government. But on my tax return, on my 1040, I would take a deduction for AGI of half of that. So they'd give me the employer's portion as a deduction. Alright, isn't that awesome? So if you're self-employed, you get to pay both sets of taxes. If you're working for the man, then you only have to pay half of it, and you know that your employer's paying the rest, and you can feel good about that. Because I do. Okay. Alright, self-employed health insurance deduction. Okay, so this is very much alive still. Okay, so we just talked about being self-employed. So if you're self-employed, most likely you are responsible for procuring your own insurance policy, rather than if you get a job somewhere, they normally have a benefits package included with your compensation where they cover a large portion of your insurance. But if you're on your own, oh, well, there's no one looking out for you. You got to look out for yourself. So you go out and you find an insurance policy, and then you get to take a deduction for the premiums you have to pay on that policy. And they should be good for yourself and I believe for your family if your spouse is not employed. All right. Penalty on early withdrawal of savings. Okay, so I guess like if you have a CD and you take it out before it matures, a lot of times they'll have a penalty on that. So for whatever reason, the government lets you take a deduction for AGI for those penalties. Okay, alimony paid. Okay, so with alimony, so basically this was designed to protect the lower earning spouse in the event of a divorce, to I guess help them maintain their standard of living or whatever they had, especially if there's family involved and like the one spouse has to take care of the kids a lot. So alimony could also be for that. it was very specific. There's some requirements for something to be called alimony. There's some specific requirements, like it has to be written in the divorce decree. It has to be specifically identified, like a dollar amount has to be paid in cash, or required to be paid in cash. It had very, very specific guidelines. Now, this is in the tax reform. They basically killed this. You used to get a deduction. Okay, so it would be deductible by the payee, or I mean the payor, the person paying it would get a deduction, and then whoever received it would treat it as income. Well, now that's no longer the case. So it's basically just like child support now. So child support was non-deductible by the person paying it. They get no deduction for it. And the person receiving the child support doesn't treat it as income. Okay, so we don't really see a whole lot of alimony in Texas. Most of the time, I only see child support. Okay, so that's not deductible, and it's also not taxable to the recipient. Alimony is now treated that same way. For alimony, it's not deductible by the person paying it, and it's also not taxable to the recipient. Now, it sounds kind of cool. It's like, oh, wow, the person who receives it doesn't get taxed on it, okay, before they were getting taxed on it. Well, the problem is normally alimony would be paid from a higher income ex-spouse to a lower income ex-spouse. So you'd have these tax rate differentials. So the current tax rates, as they are written out in the reform, the top one is, so if you're making several $100,000 a year, you very well could be in the 37% tax bracket. Whereas the weaker income spouse very well could just be in the 10 to 15% tax bracket. So what ends up happening is that, all right, well before, if, let's just say the ex-spouse with the large income was paying $30,000 a year. Okay, so that's a pretty decent check to a weaker earning spouse, like somebody with lower income. That would be a pretty good supplement. But now, say if that number was based on how much the ex-spouse could afford, well now, if he can't take a deduction for it, he effectively can only afford to pay 2/3. Okay, and why is that? Well, before he was able to get a tax benefit, which afforded him about 1/3 of every dollar, so that's why I took out 10. Well, now that he's not getting a deduction and a tax benefit for about 1/3 of every dollar, he can only afford to give away 2/3 of what he could previously. So, because of the tax rate differential, the recipient very well could get screwed by this piece of the reform. Okay, so I'm not going to make you memorize any alimony stuff. Just know that that's one of the items that was killed in the tax reform, as well as moving expenses. But just know that, okay, no longer deductible and not taxable to the recipient, just like child support. Okay, educator expenses. The main thing to know about this one, educator expenses, that's for K through 12. So like I'm not a K through 12 instructor, so I cannot take advantage of this. But it normally gets on the chopping block every year, and it's a yay or nay on whether or not they're going to extend it. And they normally extend this from year to year, but it never gets made permanent. It's $250 per spouse on the return, so if there's two people, they're both educators, K through 12. Okay, so this is K through 12, remember. Then between them, they can deduct $500, but not more than $250 each. So if one spouse spends $350 on educator stuff, and another spouse spends $100, well, the spouse who spent $350 can only deduct $250, and the spouse that spent $100 can only spend $100 or deduct $100. So you can't you can't allocate You can't cherry pick out of the 500, and like you can't apportion it accordingly. What kind of stuff is it for? It's like if you spend money like on some little game activity things for your students, or if you pay money for posters and other decorations in your classroom. Those are certain expenses that you can deduct, or some other materials for learning that you pay out of pocket, you're not reimbursed for. Those are the kind of things you can include in this amount. Yeah, and I believe that did get extended. Okay, so it looks like the last one we've got is the tuition and fees deduction. Alright, so most of the time you're going to be better off taking one of the educational credits. And so let me just write those out over here. You're normally better off taking the American Opportunity, something like that. Let me see. American Opportunity Credit. Or the Lifetime Learning Credit. Because the reason is on both of those, with a tax credit, you get a dollar for dollar reduction in tax. Whereas this one, it says you can deduct in 2016 and 17. You can deduct up to $4,000, but if you're in a 15% or 10% tax bracket, well, the only benefit you're getting, I guess, $600 of tax savings. Because remember, whatever you take as a deduction, the benefit is a percentage. Whatever tax bracket you're in, you're essentially saving that many pennies on the dollar. So in this case, if I take a $4,000 deduction, I'm going to save $600 in tax. So 10% of 4,000, 400 plus half of that, so $600. Now, if I take the lifetime learning credit and I'm in that same tax bracket, let's say that I spend the same amount of money, and let's say that they're both $4,000. So let's say I spent $4,000 on qualifying expenses. Well, lifetime learning lets you take a 20% credit, and that would be $800 of tax savings. Okay, so this one right here is just basically a percentage that they've given to me for my tax credit amount. This over here, this 15%, that's my bracket, or what we learned about in a previous chapter, that's my marginal tax rate. So one is my marginal tax rate, and one is just an arbitrary percentage that the government has come up with. Okay? So I guess they could both be considered arbitrary percentages. But anyway, one's my tax rate depending on my income. The other one doesn't really depend on my income. It's whatever my income is, so long as I'm not in the phase-out range. Remember, certain credits and benefits can disappear if my income gets too high. But assuming I'm not in the phase-out range, it doesn't matter what my income is, so long as I'm not too high. I'm going to get to take 20% of whatever I spend up to a certain amount. And on the other one, I'm only going to get what my bracket, my marginal tax rate is a savings. So in lower tax brackets, normally you're better off taking the credits. Higher tax brackets, like if I'm in the 25% tax bracket or 30-something percent, and I can qualify to take tuition and fees, I'm going to normally be better off. Now, the main thing this is for tuition and fees. It's not for books. They don't let you take books on this one. And it's tuition at a qualifying higher education, like a college. It's not for private school or anything like that. Okay, and remember, if you have to calculate a phase out, I'll give it to you on the test. I'll tell you what the phase out range is. Okay, folks. Well, I think that's it. I'll start getting the review together for your test, and I'll get this transmittal in, and Bob's your uncle. Thank you for paying attention, and have a great one.